Today, we're going to talk about the 10 RRSP strategies we've reviewed and determined the best one for your retirement. After years of helping Canadians retire, we know how important it is to find the right strategy for you. With so much information available online, we want to ensure you have access to the best retirement planning strategies. That's why we're making this video today, to help you understand the best method for your RSP and how to use it to your advantage.
Before we walk through these strategies, we want to preface that these RSP strategies aren't the complete set. And sadly, we don't have time to cover every single strategy here. So if you want a more comprehensive look at your plan, just click the first link in the description. So we'll get started with a couple strategies that our clients have brought to us over the several years and why some of them may not be the best strategy. And I'll get started with the first one. And the first one's contributing to your RSP in the last month of the year or just before the deadline. So this often is our procrastinating clients that don't think about their savings until it's RSP deadline and it's become front and center in the news. Typically, this isn't the best strategy to utilize because you're going to be taking a lot of time throughout the year where you could have the opportunity to be saving. Maybe the markets are lower in value. Maybe you're now being forced into, at the deadline, investing at a time where it may not be the most opportune time to do so. So, Carla, what are some negative consequences that the strategy can lead to?
One of the benefits of having an RSP is that tax-deferred growth. Yeah. You're under a tax shelter. So any of the investment income that your investment earns is tax-deferred. So waiting until the end of the year, you're losing out on 10, 11 months of tax-deferred growth that your investment could be earning, as opposed to either sitting in cash in a bank account or sitting in a non-registered account where it's not getting tax-deferred growth. So do yourself a favor, do your portfolio a favor, and invest as soon as possible to get longer tax-deferred growth. Now, the second strategy that we typically see from clients is contributing the minimum amount to their RSP. And so that would be where clients determine what their minimum amount is just to avoid any additional taxes payable and contribute that amount. And that may not necessarily work out long-term for you because it doesn't necessarily take advantage of the potential for the long-term growth and maximum tax benefits available. Many people see that contributing the minimum is manageable or it's safe. You know, they're leaving money in their bank account for that rainy day. But that money sitting in your bank account may not work the hardest that it can for you, as opposed to being invested in a tax-deferred account.
And that leads us to our next strategy, and that's investing in only low risk, maybe low return assets like a GIC. And utilizing your RSP, you should be able to utilize any other type of investment you like, thinking typically more long-term if it's going to be for retirement. GICs or things on more of a fixed income nature are typically a bit more of a short-term investment. So while they do offer safety, they don't offer the returns that can keep up with inflation over a long period of time. Now, if you have 20, 30 years before retirement, that's a lot of inflationary years that you're going to have to keep up with. The best way to do that, or the best way to keep up with that, is investing in a more globally diversified portfolio. So the negative consequence to investing in GICs is you may preserve your capital, but it may not leave you with a portfolio that has grown enough to meet your retirement goals, and it could potentially reduce your purchasing power in retirement.
Now, John, focusing on GICs or fixed income investments are definitely not what you want to be doing in a tax-deferred long-term account. And we often see clients allocating their portfolio, a higher allocation to bonds, which are essentially fixed income investments because they want to see safe, steady growth in their portfolio. But what bonds do is they offer protection, but what comes with protection are low long-term returns. And everybody is aware of the risk-return trade-off. The less risk you take on, the less long-term return that you will get.
Before we continue, we understand that some of this information can be a lot to take in at once. So if at any point in time you get confused or want additional help, just click the first link in the description. Next big mistake that people make is putting all your RSP funds into one stock or one sector. Now, investing all your RSP funds into one company stock or single sector could be like technology or real estate. Oftentimes people are hoping for that big return. Specifically technology, I think in recent history has done very well in terms of that individual sector. But this approach exposes you to significant risk. If that stock or sector underperforms, your RSP could suffer large losses or the opportunity cost of just being in the general market as a whole. Now, a lot of people like the strategy because it offers the opportunity or the thought that they can beat the market. Mm-hmm. Everybody wants to beat the market. Everyone wants to be ahead of where they should be or ahead of where their neighbor is. But that comes with a lot of risks that you could potentially be far off worse than potentially, what just the general market would be. So like you mentioned before with the risk-return trade-off, is the risk necessary to take on, especially for something as important as your retirement savings?
Number 6, This strategy involves over-contributing to your RSP to maximize tax deductions. And so the one downside to this is that over-contributing can result in very punitive penalties. The CRA will impose penalties on you for having over-contributions and for the duration of the time that it's in there. And most people come in asking us to do so, put more money into the RSPs, because they believe that contributing as much as possible will help them save the most taxes and build their retirement funds faster without realizing how impactful those penalties can be. So what clients were trying to do by over-contributing and having that longer-term growth, that can be offset by the penalties that would be imposed by the CRA.
Yeah. The seventh mistake that people use their RSP for is using your RSP as an emergency fund. Now, oftentimes people think they can withdraw from their RSP early to cover some non-retirement expenses, medical bills, home repairs, things like that. Early withdrawals come with its own set of penalties, and the money withdrawn can be taxed as income. So if you are still working and you choose to withdraw in your RSP, it could put you in a pretty difficult tax situation for that given year. People may think that RSP is a safety net, it can be used for emergencies without fully understanding the long-term consequences of what withdrawing early would do for your retirement. Frequent withdrawals can severely impact your long-term retirement savings. You can incur taxes, it can delay your retirement plans, and essentially reducing the compound benefits that the RSP offers.
The eighth strategy that people make the mistake of with RSPs, and that's ignoring the potential for the tax deferral. So by doing that, you're definitely not taking advantage of the biggest benefit to an RRSP, and that's that tax deferred growth until retirement. You mentioned it earlier in that last point. Some clients think it's okay to use the money early, thinking they can catch up later. But what they're missing out on is that long-term compounding growth in a tax deferred environment. And if you are pulling funds out of your RSP early, like you were mentioning earlier, and you're still working, all of that money coming out of the RSP is going to sit on top of any other income that you earn and potentially push you into a higher marginal tax bracket.
And finally, the last mistake that people are making with their RSP is not rebalancing the portfolio within your RSP. So once you've set it up, you leave it unchanged without regularly reviewing or rebalancing your investment choices. Over time, the risk profile of your investments may drift. You can miss opportunities for growth or potentially mitigate a lot of risk that goes on with these changing allocations. People often believe that once they've made their investment choices, the account will continue to grow without needing adjustments, but this leads to missed opportunities. Failure to rebalance can expose you to unnecessary risk or underperformance. Your portfolio can become too aggressive or maybe even become too conservative. So this can really impact your retirement as a whole. So let's take a look at an example of a client that we had dealt with. They were on the track for retirement. This client was 50 years old, so about 15 years away from retirement. Based on their current saving strategies, where were they headed and where could we improve upon? So with this client, as I mentioned before, they're 50 years old. There's 15 years remaining to go until retirement. They were contributing about $5,000 per year to their RSP at the end of the contribution period. So right before the deadline, every year was about $5,000. Their marginal tax rate was approximately about 40%. So they were a pretty good income earner, and they were getting a pretty good tax savings on this contribution that they're making to their RSP. However, the money that they've been putting into their RSP, it was being invested in something a little bit more on the short-term side. They're a big fan of bonds or GICs because they wanted that security. So with that security comes a expected lower rate of return. And also they were not indexing their contributions over time. As their income was continuing to grow, they were continually doing their $5,000 come the RSP deadline. So with that assumption and continuing on over the course of the next 15 years, they would get to a retirement at age 65, and their RSP that started at $100,000 would be about $248,000 after that 15-year period. Not bad. They still made their contributions. They still had growth go on within their account, but there is a lot of opportunity to improve upon that. So Carla, why don't we talk about what our suggestions were and how we can improve that situation for our client?
Of course. Thanks, John. Now, for the new scenario, we implemented strategies that corrected the mistakes from the previous scenario. And for this, still starting with an RSP at $100,000, but we've changed the RSP contributions from annual to monthly to capture that longer tax-deferred growth, getting contributions done earlier than later. And what we started doing was increasing the contributions every year according to inflation. And on top of that, utilizing the refund that was generated from the contributions. So on a $5,000 contribution that would at a 40% marginal tax bracket, that would be $2,000 in refund. If we just divide that over a monthly basis, we've increased the monthly to $583. And on top of that, we've invested the money into a portfolio of stocks and bonds. And what that is going to do is provide a higher investment return over the long term, as opposed to just being in GICs or higher bond exposure. So the return rate would be 6%. So after 15 years, starting at a value of $100,000, the end result would be approximately $440,000, which is almost $200,000 increase by just making those minor tweaks.
Now you should know the best strategy for your RRSP. After years as a financial planner, we found that this strategy drastically increases your plan success rate. However, it's important to remember that your RRSP strategy is just one of many factors to consider when planning for retirement. If you focus on this strategy alone, there's going to be a significant chance that your retirement could still fall short. So to make sure you have all the information you need for a successful retirement, we've created a completely free video just for you. We break down exactly what to consider and how to use this information to strengthen your plan. That way you have a clear direction of what changes you need to make before it's too late. To watch it, just click the first link in the description. We'll see you in the next one.